In this video, we're going to recap on supply and demand. So we start with the demand base, the market makes a base, and we get a very fast impulse move out of that base. Now typically when retail sees this, they'll FOMO into the move, they'll buy at the top, and then the market will retrace this fast, inefficient move. When the market reaches that demand base again, that's when smart money will buy and retail capitulates, and then the market goes back up. So that's demand. Now let's have a look at supply. Supply is the same. We get a base, the market makes a very fast move out of that base, retail sells at the bottom, they FOMO in, the market retraces that fast, inefficient move, and then smart money will sell from that base, and that's where retail will typically capitulate and close at a loss, and then the market continues on down. There's two ways you can draw a demand zone. The first is to make the upper bound at the point where the market moves away very quickly, so you can see that here, and then the bottom of the zone, the lower bound, will be below the wicks. But what if you can't see the exact place where the market has moved away? Well, in that case, the second way of drawing it is to line up the zone with the candle bodies. So the upper bound will be at the point where the candle bodies line up, and then the lower bound will be below the wicks. So that's demand. And with supply it's the same. The market makes a move out of the supply zone, and where it made that very fast move is where the lower bound will be, and then your upper bound will be above the wicks. And if you can't find the exact place where it made the move out of supply, then you can use the candle bodies, the opens and closes, and you can use that as a lower bound of your zone. Here we have some examples on the 4-hour Australian dollar chart. Now you can see here we've got a supply zone, and we had a candle close, a candle open, and we also had a very fast move away. So it's very easy to spot where the lower bound of this zone is. This is the exact point where the market moved away quickly, and you've also got the candle opens and closes to help you define that zone. And then we've got a wick here, so I've used that wick as the top of the zone. We've got another zone here. Now in this case we didn't have the candle bodies, but we can see from this point here there was a very fast move away, so that's why I use that as the upper bound of the zone, and then I use the wick here as the lower bound of the zone, and when the market came back it made a bounce. And just a quick tip, when looking for supply and demand zones, look for the impulse move first. Once you've found a fast impulse move, then you can work on defining the zone. Okay, that's it for supply and demand. I'll see you in the next video.